Over 1.2 million Canadians are about to walk into a financial storm they didn't sign up for. The biggest wave of mortgage renewals in recent history is crashing into 2025 and 2026, and it's going to hit hard. Imagine you bought a home in 2020. You locked into a mortgage rate at 1.7%, possibly even lower. Life was manageable. But fast forward to now, and suddenly you're looking at your renewal at 4.5% or even worse. That could mean hundreds, sometimes over thousands of dollars more a month for the same house, same salary, same lifestyle, just a new reality. So what happened? Why is this happening now? And most importantly, what can you do to survive? This video is for every homeowner, future buyer, or anyone who is just trying to make sense of how mortgage rates could change their financial life. We're going to walk through everything you need to know about the mortgage renewal crisis. And it is a crisis. Not just because rates are higher, but because most people aren't ready, because lenders are preparing for pain, because most Canadians haven't faced this kind of rate shock in their lifetime. So here's what we'll cover. First, what's happening right now? Why so many people are being affected at once? Second, how we got here. What caused rates to climb so fast and what mistakes were made along the way? And third, and maybe most importantly, what you can do to protect yourself. Whether you're renewing now, next year, or just trying to get into the market. This is not a scare piece, but it's a reality check. And the sooner we face it, the better prepared we'll be. Because 2025 and 2026 might be painful, but it doesn't have to be a disaster. So let's break it down. Let's start with the big picture. Over 60% of mortgages in Canada are renewing between now and the end of 2026. That's more than 1.2 million households, each facing a steep jump in monthly payments. And why is this happening? Because rates were rock bottom just a few years ago. In 2020 and 2021, the Bank of Canada slashed interest rates to stimulate the economy during COVID. That led to historically low mortgage rates. Some people locked in at just 1.5%. But those days are gone. Today, the average 5-year fixed rate is hovering around 4.5%. And for many borrowers, that means renewing into a payment that's hundreds, sometimes thousands of dollars more each month. Let me show you exactly what that looks like. Imagine you have a $600,000 mortgage with a 25-year amortization. At 1.79%, your monthly payment would have been around $24.70 a month. But at 4.5%, that same mortgage now costs about $3,332 a month. That's a difference of $862 every month, over $10,000 a year. And most people aren't getting a $10,000 raise to make up the difference. So what happened? How did we go from near zero rates to this? It comes down to inflation. Starting in 2022, inflation skyrocketed, caused by supply chain disruptions, pandemic recovery, stimulus spending, and the war in Ukraine. Prices were rising faster than we've seen in decades. To cool things down, the Bank of Canada had one lever: interest rates. So they started hiking, and they hiked them fast. In just over a year, the Bank of Canada raised its key interest rate from 0.25% to over 5%, the fastest tightening cycle in generations. The goal? To slow spending, reduce inflation, and bring the economy back into balance. But here's the problem. Interest rates don't just affect new loans. They hit everyone renewing too. And now we're seeing the consequences of that. For fixed rate borrowers, the pain showed up at renewal time. For variable rate borrowers, it's already been happening. If you're on a variable rate with an adjustable payment, your mortgage has been getting more expensive month by month. If you're on a variable rate with a fixed payment, there's a good chance you've already hit your trigger rate. A trigger rate is when your payments aren't even enough to cover the interest anymore. That means your mortgage balance is actually growing, even as you make your mortgage payments monthly. In some cases, borrowers are being forced to increase their monthly payments. In others, they're refinancing early to avoid even worse terms later. And that's leading to growing numbers of forced sales. In the GTA, for example, power of sale listings, those homes being repossessed by lenders, are more than doubled over the past year. That's not a flood yet, but it's a serious warning sign. We're entering an environment that we haven't seen in decades, where mortgages are not just expensive, but dangerous if you're not prepared. And it's not just about homeowners. it impacts real estate investors too. Rental property owners who bought with low rates are now renewing into higher ones. If they can't raise the rent to match the cost, they're losing money every single month. Some will hold on, hoping for relief. Others, they'll sell. And that could create more inventory in the market that's already softening. And that also affects renters. When landlords are forced to raise rents or exit the market, it puts pressure on tenants. So this isn't just a homeowner's problem, it's a ripple effect moving through the entire real estate system. And here's where it gets real sobering. Many Canadians are not ready for this. Household savings have been declining since the peak of the pandemic. Credit card debt is rising. Lines of credit are getting maxed out. According to a recent survey, more than 57% of people renewing their mortgage expect financial strain. Some are worried they won't even qualify at all. And we haven't even hit the peak of the renewal wave yet. Lenders are bracing for defaults. Economists are warning the potential jump in delinquencies. And the central banks are caught in a bind. If they cut rates too soon, inflation could come back. If they hold rates high, they risk the wave of financial distress. So what happens now? Some households will manage. They'll adjust, budget tighter, maybe cut discretionary spending to make room. Others will refinance, extend amortizations, or lean on family to bridge the gap. But for many, this will be a wake-up call because we've spent over a decade with cheap debt. We've grown used to homes being affordable at 2%. But the market is now relearning what housing looks like at 4, 5, even 6%. And it's a different world. The housing boom we saw during the pandemic wasn't just about demand. It was fueled by low interest. Now the reverse is happening. Demand is softening, prices are correcting, and debt is getting expensive. So if you're feeling nervous right now, you're not alone. What matters is what you do next. So now that we understand the scale of the mortgage renewal crisis and what is happening, let's talk about what you can actually do about it. Because yes, this is serious, but it's not hopeless. You still have options, you still have leverage, and how you act in the next few months could make a huge difference to your financial health over the next few years. So here are 5 practical, no BS strategies that financial experts, brokers, and seasoned homeowners are recommending. Strategy number 1, don't auto-renew. I get it, you're busy, you're stressed, and that letter from the bank makes it seem the easiest thing that you can do is just sign and move on. But here's the thing, lenders almost never offer their best rates at the first renewal notice. They count on you being passive, you can negotiate. Or better, use a mortgage broker to do that for you. They'll shop around, compare offers, or often sometimes find you a better rate. Even if it's just by 0.5% over 5 years, that could mean thousands of dollars in savings. Strategy number 2, consider extending your amortization. This isn't ideal long-term because it increases how much you'll pay in total interest. But if you're in cash flow pain right now, stretching from 20 years to 25 or from 25 to 30 years can give you some breathing room. It's a short-term lever to keep you afloat, not a permanent solution. Use it wisely. Strategy number 3, if you're on a variable rate or you're near or already past your trigger rate, talk to your lender immediately. If you wait too long, you might be forced into higher payments or worse terms. Locking into a fixed rate might not be ideal, but for some, the stability is worth it, especially if you're feeling the stress of rate fluctuations every few months. This isn't about guessing the market, it's about knowing your tolerance for risk and making a plan that lets you sleep at night. Strategy number 4, if you can afford to, make lump sum payments or increase your payment frequency. It doesn't have to be massive, even $50 or $100 each month. It cuts your interest, shortens your timeline, and gives you more equity faster. Think of it like financial weight training. You won't see results overnight, but a few months or years from now, your future self will thank you. And finally, strategy number 5, don't wait until you're in a crisis to talk to your lender. Lenders don't want you to default. They don't want to repossess your home. It's expensive, it's slow, and it doesn't look good for them. If you see trouble coming, whether it's a renewal that you can't afford, a job loss, or a spike in your expenses, reach out early. Restructuring your mortgage before you default gives you more flexibility and way less stress. Remember, this isn't about pride, it's about survival. Financial hardship doesn't mean failure, it means you're human and you're adjusting. And here's the bigger picture. You're not alone. Millions of Canadians are going through the same thing, quietly, anxiously. Many of them haven't told their friends, haven't told their family. They're hoping things will get better on their own. But the people who will get through this the best are the ones who prepare, who take action now. So please share this video with someone you know that is coming up for renewal. Drop a comment below if you're going through it. Let's open up this conversation because financial stress thrives in silence. And remember, panic is not a strategy, but preparation is. I'm Justin Chaussee, and if you found this video helpful, please like and subscribe so that we can continue to make more videos like this for people like you. Thanks for watching, and I'll see you in the next video.